we have had the highest and fastest level of interest rate rises for many years over the past couple of years. And if you think about what higher interest rates generally means, it generally means a slower economy. Central banks tend to increase interest rates to slow down the spending, increase costs of borrowing, and try to slow down the overall growth of the economy. And we've had really fast interest rate rises globally over the past couple of years. It's starting to turn the other way now, but those high interest rates are flowing through to things like, for us in Australia, higher mortgage rates, and you add on to that the fact that we've had high levels of inflation as well. For us, that could provide a bit of a headwind for economies going forward.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke, Britton Financial Partners.
This is episode number 117 of the Finances podcast. Today's guest is Edward Leung from Macquarie. Ed's a senior investment specialist, client portfolio manager, specialising in sort of the fixed income team. Ed, thanks for joining Ben and I on the Finances podcast today.
No, thanks for having me.
I know we were just chatting off air before we started recording, but fixed income, fixed interest, some people will know what we're talking about. Others will maybe think they know what we're talking about. I thought maybe before we jump into a little bit of your background, let's preface this conversation with what is fixed income, what is fixed interest, and how does it differentiate from other investments that people might have in their portfolios?
Yeah, definitely. I think fixed income is one of those asset classes that unfortunately not a lot of people are that familiar with. I think, I grew up watching the evening news, and, whenever whoever it was at that time, Channel 7, spoke about finance, they would always talk about, what happened in the share market for the day. They talked about what the Aussie dollar was valued at for the day. They may talk about the economy for a little bit, but they rarely ever talked about what was happening in bond markets or fixed income markets, even though in reality, if you think about a overall diversified client's portfolio, there would be, you would expect some element of fixed income or bonds in there. So I think it's part of the way that we've sort of grown up, that we just haven't had as much exposure in the overall society to fixed income and bonds. And if I were to simplify what is fixed income investing and what are bonds, it's essentially a defensive asset class where instead of investing in the shares of a company, you're investing in the debt of a company. And so what you're doing essentially is you're lending to that company with the expectation that that company or issuer, and there's different types of issuers that we can talk about as well, will pay back that money to you at the end of that bond's life, or the maturity or the term of that loan, plus a level of interest or coupon over the life of the bond. I think a good analogy to maybe reference here is you're almost taking your own money and your capital and acting as a bank. So you think about a bank's got heaps of cash and deposits. They make money by lending to people. And to, I guess, generate the profit from those loans, they charge an interest rate, and that interest rate will cover their risk plus a profit margin. For fixed income investors, you're almost acting as that bank. You're the lender, you're lending the capital, you're expecting to get your money back plus additional interest, yield and coupons and so forth. That's at the very sort of high level. And then underlying that, there's heaps of different types of bonds, different issuers, different types of risks that you can be exposed to. So it can be quite complicated, but at a very high level, it's just a defensive asset that most people would already have exposure to in their portfolios, but they may just not pay a lot of attention to it, given that there's not a lot of coverage of it in the sort of general media and so forth.
A lot of people just simply don't understand it. And when people don't understand what it is, they fear it. And I think for a lot of the feedback we see from people that haven't had a lot to do with investing in bonds is that they're more scared of investing in bonds or fixed interest instruments than they are of actually direct equities. And it's just because of what they do or they don't know in their own experience, or probably like you were saying, even what you see when you turn on the news at night, they don't tell you about bond yields or anything, do they? So that unknown piece. I thought this today would be a good chance for people to learn a little bit. And I think your summary there was really good for people to just understand what they actually are. People have historically invested in term deposits and direct equities, and that's about it. Has been historically a lot of that, but finding those instruments that fit in the middle ground of that to complement those strategies is crucial. A lot of people have industry funds which would have potentially 20+% exposure, maybe even higher than that, to bonds and other fixed interest options, but they're not even aware of that. So no doubt there's a lot of that needs to be, I think education is the key for most people.
Definitely. Yeah, 100%. And that's what I really like about my role, being able to share that information and sort of make people a bit more aware of fixed income. And even for you guys, I would imagine as financial advisors, you being able to pass on that information around fixed income investing and the importance of it in the overall client's portfolio to meet their investment objectives would be a big part of your roles also.
Yeah. Before we get to some hard-hitting questions around the market and fixed income, fixed interest, can you tell us a little bit about your backstory, Ed, and the Macquarie team? So how you found yourself where you are and who makes up the team? Whereabouts are you guys situated?
Yeah, sure. So I guess being in the fixed income team, my background story is probably not that exciting, but I've been in Macquarie in the fixed income team for just over 15 years now. So I started my career back in the day more in the accounting space. I did a sort of finance and accounting degree originally. Started my my first role in KPMG. Got my accounting certification. Did a few years there, and then sort of decided that maybe that wasn't for me. And it was a great sort of role, no doubt about it. And I learned a lot during that time. But for me, the accounting space is a bit more backward looking, looking back at the accounts and what happened over the past year, as opposed to, what's going to happen. And my interest sort of lay more in what could happen going forward and what do we do about that, as opposed to sort of always reviewing backward looking information. And so since then, I've sort of been part of Macquarie Asset Management's fixed income team. And my role at the moment is, as you mentioned, Jay, investment specialist or client portfolio manager. I'm part of a team of around 180 investment professionals just within fixed income, and Macquarie Asset Management is an even larger team than that. And I'm located in Sydney, but we are a global team, and we have offices in Sydney, Philadelphia, New York, London, Wellington, as well as a whole bunch of other people in sort of other more bespoke locations as well. And that's really important for us, given that we're a global fixed income manager. Our investment solutions that we offer to our clients can invest into pretty much the whole spectrum of global fixed income markets, and having that investment team located around the world is really sort of beneficial for that.
It's interesting hearing you talk about the backward-looking tendency of accounting, and it's a similar theme for us that particularly went from a financial planning point of view. I think that's one of the reasons why we align so well with the sort of fund management element or investment management element for our clients, is that it's very much about looking about what the opportunities are, looking at what our clients actually need, looking at what they require in terms of capital protection, but also what they require as far as income. Because a lot of what we do is make sure that we fund people's lifestyle, the lifestyle that they want to live, and that's kind of dependent upon them making the most effective use of the income and the assets that they actually have. I was fortunate enough a couple of weeks ago, I did a walking tour with InvestSense group that we work closely with in Sydney, where we met a couple of your competitors in the fixed interest space. One of the interesting things that sort of came up just broadly around that was how you actually differentiate yourself in the fixed interest space. And if I think about how, from a client level, people think about fixed interest, we said that a lot of people maybe don't know what fixed interest, fixed income is. but also having a little bit of knowledge around a topic can be dangerous. I think one of the concerns for a lot of people is that they see fixed interest or fixed income, almost like Ben said, as a term deposit, and this idea of volatility in your capital. If we're not careful, people are under the assumption that we're investing in an asset class that has no risk or potential to have fluctuations in the capital. So I suppose that the broad theme was there is how do you differentiate yourself in the fixed interest space, given that you got 150 odd people in your team, and there's a bunch of other fund managers out there trying to get share of client investment purse in their sort of defensive fixed interest space. How do you differentiate yourself in that fixed income, fixed interest space?
Yeah, definitely. Maybe before I answer your question, Jay, I think you made a good point in terms of, some of those myths around, or I guess not myths, but misunderstandings of fixed income. Given the name fixed income, people do sometimes feel like it should be an asset class where there isn't volatility, where there's some sort of guarantee on the return or the performance of those strategies. And unfortunately, that's not the reality. I think, fixed income, as much as it is a defensive asset, there is still mark-to-market pricing of bonds, which leads to some level of volatility. I think the main thing to note here is that the volatility that you generally experience in fixed income through the market cycle tends to be less than some of the riskier assets such as equities. And that's where that fixed component of fixed income comes from. And then assuming that you hold a portfolio of bonds through to maturity, and depending on the credit quality and so forth, and assuming there's no default, the fixed nature of fixed income is that you get your capital back. Whereas when you're investing in equities, you don't know where those equity valuations may end up. But definitely on a day-to-day basis, if you're looking at the valuation of bonds, they do fluctuate, and not many things in life are guaranteed or don't have any volatility in investing, and fixed income is one of them. It's just that through the market cycle, it tends to be a more defensive asset class. I guess to now answer your question, Jay, in terms of how do we differentiate ourselves in Macquarie fixed income compared to other fixed income managers in the market? I think the first thing to comment on is probably the differentiation between sort of your passive managers and your active managers. At a very high level, passive managers, they follow a benchmark. They create portfolios that just mimic the exposures of a particular benchmark, in our case, fixed income benchmarks, and they give you the return of that benchmark through the market cycle without sort of adjusting depending on what's happening in the market environment. A more active fixed income manager, can start with a benchmark, or they can take a more active approach where they're taking into account what's happening in the market environment, what central banks are doing, how the economy is performing, to adjust the exposures in the portfolio. So for us in the fixed income team, we're very much more active fixed income manager as opposed to a passive fixed income manager. So that's for me the starting point for differentiation. And we can talk about the benefits of active and passive approaches if you like, but that could probably take a whole episode in itself. And we're not saying that passive is bad or anything, but it's just how we differentiate from some of the other fixed income managers in the universe. I think the other thing for us is that Macquarie has been managing fixed income for almost over 40 years, depending on sort of the different asset types within fixed income markets. At the moment, we're Australia's largest fixed income manager within the Australian fixed income space, and over that time, we've been managing fixed income portfolios through changing market conditions. Over that time, we've built very strong partnerships with our clients and continue to deliver, the outcomes that we intend to deliver for our clients. And for me, that's a key differentiation to our peers as well, in the sense that we've been able to prove to some extent our ability to manage fixed income portfolios in an active way through the market cycle and deliver the outcomes that clients expect. And the way that we do it is through that active approach. And for us, depending again on the specific solution that we're talking about, we do take into account a lot of different processes for building our portfolios, which adjust the risk exposures in the portfolio according to what we think the market environment is like and our outlook for markets going forward.
Look like Ben just got kicked out.
I just got booted out. Sorry. Probably again, when you talk about the outlook moving forward, I had scribbled there is what do you think? Again, broadly speaking, from the market perspective, like where are we at? Like I think everyone's been sort of, again, hanging on to get through the US election, and maybe whether that is a big issue for your markets you're looking at with the fixed interest stuff. But sort of where do you feel things are at in that cycle, and what is next on the outlook for you guys?
Yeah, definitely. So I think to answer that question, Ben, it might be worth just reminding ourselves where we are now at the moment. And, we've been having a lot of client conversations recently. And generally speaking, I would say that clients overall are quite happy this year, particularly compared to previous years where we've had much more volatility. I was just working on a presentation for a meeting next week. And one of the slides that I'm putting together is just reviewing the 12-month performance across different asset classes. And I have it on my screen here. And over the past 12 months, global equities is up 30%. Australian equity is up almost 25%. Investment grade and high yield credit within the fixed income space is up 10 to 15%. Australian and global fixed income 7 and 8%. So everything has been performing quite well this year. So the starting point is that people should be quite happy. The outlook going forward, and again, we're always thinking about things from a fixed income investor perspective. And given that we manage the defensive part of a client's portfolio, some of our bias is often towards managing the downside as opposed to thinking about all the upside. Not to say that we don't take advantage of opportunities in the fixed income space, but we do appreciate that we are managing the defensive part of a client's portfolio, and we would like to be aware of all the potential risks. And right here, right now, we are seeing probably some level of downside risks arising in the economy as well as markets going forward. I mean, part of that is just the fact that, if you look at equity markets, for example, they're pretty much at all-time highs. And, how high could they go? They could keep going higher, but at one point you would expect there to be a sort of a repricing of those markets that have performed so well to date. I think when our team looks at the overall macroeconomic environment, we're also seeing that global growth is starting to decline as well. And a lot of that is driven by the fact that we have had the highest and fastest level of interest rate rises for many years over the past couple of years. And if you think about what higher interest rates generally means, it generally means a slower economy. Central banks tend to increase interest rates to slow down the spending, increase costs of borrowing, and try to slow down the overall growth of the economy. And we've had really fast interest rate rises globally over the past couple of years. It's starting to turn the other way now, but those high interest rates are flowing through to things like, for us in Australia, higher mortgage rates, and you add on to that the fact that we've had high levels of inflation as well. For us, that could provide a bit of a headwind for economies going forward. So we're probably at the moment tempering clients' expectations in terms of the market outlook going forward, particularly on some of those asset classes that have performed very well. I would say that in the fixed income space, however, given the outlook for economies may not be as strong, having a higher allocation or maintaining your exposure to your defensive assets such as fixed income is not a bad way to potentially position going forward, because if you think about those higher interest rates, that has actually translated to higher bond yields. And if you think about the concept of you being a lender and getting the return of higher interest rates or bond yields, now is actually not a bad time to be having some level of more defensive assets, given that you're getting paid a better yield or rate for investing in that space. So that's at a high level our thoughts going forward.
With just on that, and without being too pessimistic on the downside risks, other than slowing global growth, are there any other Are there any other things that you could point to, maybe that directly would impact negatively the fixed income, fixed interest space that you're kind of aware of or keeping your eye on? And I suppose and you tell me whether this is unusual, Ed, in broad terms, but I was just thinking the other day, like we're in an environment at the moment where you said the equities are at all-time highs, interest rates are at kind of rates that a lot of people haven't seen before. Defensive assets like gold are elevated, alternative investments like cryptocurrencies are through the roof. There's a sense, I think, without being too pessimistic, that there's a lot of these assets are fairly heavily valued at the moment. What, other than the slowing sort of market or economy risks or market risks or growth risks, what else is out there that we should be aware of or that you're thinking about?
Yeah, sure. So I think the funny thing is, what tends to be good for equity markets sometimes is bad for fixed income markets, and the converse is potentially true as well. I mean, one of the big things that probably everyone is looking at, and for us definitely, last week, we were glued to our screens waiting for the outcome of the US election. So the election and the potential impacts of President-elect Trump's administration and what policies they may put in place is definitely something that could change market dynamics as well. One of the things that a lot of people are talking about, and we're quite conscious of as well, is the amount of potential fiscal spending that comes out of the US going forward. If you think about spending as increased borrowings from the US government, that could be potentially negative for fixed income because at a very, very high level, not to say that the US government is a credit risk, but the more you borrow, the greater your credit risk generally, and that would result in higher bond yields, which would be negative for bond prices. So that's something that we're quite mindful of. I think the other thing that sort of offsets that, and it's, I guess, if I sort of relate that back to equities, increased fiscal spending could actually be good for the economy and good for equity valuations as well. So, if that's good for equities, then it could be a headwind for fixed income. But at the same time, if you think about where interest rates are and where bond yields are, we're in an environment where we have huge amounts of global debt. If you look at the US government, they've been spending massively over the past many years actually, and if you look at household debt, they're fairly high levels, and in an environment as you mentioned, Jay, where bond yields are fairly elevated still, there is going to be a limit on how high bond yields could go before they sort of retrace, and so we're waiting to see the impact of those potential policies that Trump has been talking about to really understand what that impact would be on spending, what the impact could be on the economy, because it could go both ways in terms of how high bond yields could go before they retrace, given the amount of debt in the economy, how much further upside there could be for equities before those higher interest rates and bond yields also affect the valuations of those equity companies and their costs of funding and so forth. So there is a fair bit of uncertainty that we're conscious of when it comes to the outcome of the US election and the potential policies that are implemented next year.
This might be more of a specific question. We're going back a little bit to something you said earlier, Ed, but talking about maybe sort of the risk reward sort of profile of different bonds that you take on, and as an example, again, the sort of the government versus a corporate, and I don't know, just a little bit of a bit of education, maybe again on the differences in the bonds and different yields. And again, it's all about that. We talk about it with clients on the risk reward broadly of their risk profile, but how you assess the bonds and how you sort of stagger those out.
Yeah, definitely. So, when you invest into fixed income markets, one of the considerations or one of the initial considerations that you want to make, and again, using the analogy of yourself as a lender, is who you want to lend to. And those lenders are what we would call issuers in the fixed income market, because they're issuing the bonds that you're buying or lending to the company on. And so if you think about those underlying issuers, in the fixed income space, there can be a range of different issuers, and they range from entities such as governments, and governments can include developed market governments such as the US, Australia, and so forth. And it could also include emerging market countries as well. So even within governments, there's different types of governments that are issuing bonds. The other sort of main part of fixed income issuers are corporate issuers, and corporate issuers are basically companies. Some of them are listed, some of them are unlisted, but they're businesses that run in different industry sectors. In Australia, a lot of banks and financial services issue bonds. Utility companies can issue bonds, infrastructure companies can issue bonds, food and beverage companies can issue bonds. So the starting point for the type of bond that you're investing into is, do you want to have government bond exposure or corporate bond exposure? And the difference between those two things is at a very high level, again, credit risk. If you think about a government entity that's issuing a bond, that's backed by that government. If you're investing in a developed market government like the US, the credit risk is fairly low, and it's probably similar for Australia, where it's very unlikely that they're going to default and you're not going to get your money back. Because they have lower credit risk, the return or the yield that you're getting for lending to that entity, that government, is probably a bit lower. As you extend down the sort of credit spectrum, if you then think about lending to a emerging market government, the credit risk would increase depending on which emerging market country you're talking about. And there have been instances where some emerging market countries have defaulted, which you don't like to see. But you also get compensated in terms of the yield on offer for investing into emerging markets governments. And then in the corporate space, you have a range of different companies that are issuing bonds, and they would have more credit risk because those bonds or those loans are only backed by that particular company's balance sheet and operations and cash flows and so forth. So, you would get compensated more for that credit risk, but the starting point is that sort of decision on what type of borrower or issuer you want to invest or lend to.
I suppose it's probably the reason.
Sorry,
Jack. So the reason why we use you guys is you have 180 people there to assess individually all of those different bonds, and then put them together into a fund where we're mitigating risk. You have some pretty safe government or really safe, secure government ones with some more risk sprinkled in around that to try and generate that upside. People could go and buy direct bonds. I think you still can do that. Again, on the market, there was a period of time people were doing it, but again, using the specialists and the diversification of that is crucial.
Yeah, definitely. And there will be times where you want to have more government bonds than corporate bonds. If you think that you're heading into an environment where, credit risk is elevated, or you're not getting as much compensation for investing into corporate bonds, you may want to hold more government bonds. And that's one of the benefits of an active approach to fixed income, where you can decide where you want to have that risk, as opposed to sort of the more passive approach where you're always getting the same exposure to government bonds and corporate bonds, where in reality, depending on where you are in the market cycle, different bonds can potentially perform differently.
I was just thinking, when you're talking about diversification and sort of managing risk, obviously one of the ways to manage that risk is diversification. Obviously, having a team that looks at many different types of bonds. Are there any other ways to sort of hedge against the risks of that you accept when you're investing in different types of bonds? I was just thinking about a presentation I went to a couple of weeks ago talking about sort of the secondary market and sort of short exposure, or basically betting on particular companies not being able to meet their commitments as issuers.
I guess maybe just to rephrase your question, Jay. So your question is around whether or not there are other ways to diversify a fixed income portfolio outside of just the types of issuers. Is that right?
Correct. Yes.
Yeah, sure. So I think, within the fixed income space, the type of issuer is one way of diversifying the portfolio and one way of constructing your portfolio as well. If you go down the levels of portfolio construction for investing into fixed income, other things that you would be starting to consider is credit quality. So even within those types of issuers, they will have different credit quality, and credit quality is basically the amount of credit risk. And there are external agencies like S&P and Moody's that assign credit ratings to different issuers, and taking that into account when you're building your portfolio is important as well. And so if I think about, for example, within corporate bonds or companies, company bonds, you can have really high quality investment grade issuers that have very low probability of default. They're going to offer a lower yield or lower sort of return potential. And then you have on the other end of the spectrum what I call high yield bonds or sub investment grade bonds, which have higher levels of credit risk and potential default risk, but you're getting compensated for that. When you're building a portfolio, you may want to be diversified in terms of how much investment grade exposure and how much high yield exposure you want to have in your portfolio, because again, they will behave differently depending on the market environment. The other thing, I think you were sort of alluding to this as well, Jay, is like those types of bonds, those issuers also issue different types of bonds. And one, I guess, type of bond that, or one characteristic that those issuers can decide on when they're issuing those bonds is the maturity of those bonds, or for us as a lender, how much we want to lend, how long do we want to lend to those companies or issuers for. And you can have companies that issue more shorter dated bonds, bonds that we repay in, say, 1 year, 3 year, 5 years. You could have bonds that repay in 7, 10 years. In the government space, you can have bonds that are up to 30 years of maturity. And for an investor, having that diversification, or for us, the active selection of what bonds to hold across the maturity spectrum is another way to diversify your portfolio as well, depending, for us anyway, on our market outlook.
Yeah, it is. It's interesting once you do start to sort of scratch the surface from very vanilla understanding of what fixed interest and fixed income is. You start to see that there is an enormous universe of different types of bond and fixed interest investments, but also the importance of actually having a team of people that understand the differences between them all and can diversify and manage that risk. I think it's a really important thing to note for investors, for sure.
Yeah.
Then you were going to say something.
I was just going to say, like, I think Ben made a good point that you can actually buy your own bonds directly on the ASX these days. I remember back in the day, this is many years ago, I'm probably showing my age, but I remember in high school, our economics teacher was teaching us about bonds and yields and so forth. And he said that one thing that you could do if you wanted to start investing in bonds is go to the RBA website, fill out a paper form. I can't remember what the minimum investment amount was, but you could buy a bond certificate from the RBA directly, which no one ever did because it's just amazingly difficult and probably not many people knew about it. But these days you could actually buy them on the ASX, but that bond, the range of bonds on the ASX are very limited, and you're just not going to, for a lot of people, not going to be able to distinguish, which bond is the good one to buy, just because it isn't as easily accessible for a lot of investors.
I think your point earlier is that you don't always go for the bond that has the highest yield, because there's, again, then that from a really simple point of view, if people just line the bonds up with little knowledge, they'll probably just pick the one with the highest yield, thinking it's somewhat like a term deposit. But there's so many other factors that go into it, and that's why
exactly.
That's why you got to do it.
Yeah, can I just share? On that point,
Yeah.
I'd share just a very quick anecdote, and I don't want you to give me any advice here, Ed. Ben can reply to this one, but I had a client who sent me, this is in the last 24 hours, a prospectus for a bond investment in the UK. I won't name the provider, and said 24% return, 2 years, capital guaranteed. They were his words. And so I spent a bit of time just in reply saying that, well, I think I said bullshit to begin with. But my extension of that was basically an education to saying, as we accept more risk, there is the potential for a greater return. But it's a spectrum.
Yeah, I think it's always, if it's like a little bit of, if it sounds too good to be true, it probably is. But it's all, and I think that's the same thing with bonds. And it's like if you hold cash, you get very, very little return, basically no return maybe, but you've got your cash, and then you go all the way up to the most speculative share, and it's going to be high risk, but potentially high reward. It's always potentially, like with those. So the bonds just also fit on that continuum, and then we need to be mapped out and work together. It's not just having one or two bonds. People think when they go into even a bond fund, and this is where, again, I think the education of this is so important, is you're not buying a bond, you're buying an absolute multitude of bonds and other tools that you probably fit in around that to protect yourself and your position as well. It's complicated, but it's also essential. So I think we don't shy away from having them in there. And education on equities is actually easier, I find, than it is on bonds, because people can sort of resonate with a company or the story around that. So being able to provide them, something like this podcast to help them get a basic knowledge of it gives them more comfort in understanding what they've got, hopefully using it in their portfolio.
Yeah, no, definitely. I think, that's if that offering was true, I think everyone would be piling into that. What was it, 24% capital guaranteed as well?
Yeah.
That's
well,
that's pretty amazing.
as I dug a little bit deeper, there was some wording around offering capital protection. Anyway, that it was a good exercise in just educating around, and I love those questions. Like we genuinely do. Like if any of our clients are out there listening and they have things that come across their desk, we love that opportunity to actually educate clients about it. And as Ben said, the podcast is an extension of our education for our clients, to actually give them a little bit of a peek under the hood of the people that we work with, the expertise that sits in and around our business and our client portfolios. And yeah, it is a complicated world, but with the right people in the right places making the right decisions, we get the end outcome as it should be for our clients. Now, I'm very mindful of time, Ed. I know Ben and I always say this on our podcast, we could continue to talk for hours. I'm sure there's a couple of topics we could go into for an hour or two in their own, but I want to be respectful of your time. Can you maybe just in closing, how can people understand a little bit more about Macquarie, about the fixed income and interest world that you work in, and where can they find you? Where can they find information about what you do?
Yeah, definitely. So, if people want to reach out to me, I think the best place is LinkedIn, or just go through Macquarie Asset Management's websites and, our relationship managers and so forth. Actually, if you are interested in learning more about fixed income, I actually have to check with our marketing team on where this is at, but we are in the middle of launching a fixed income education hub on our website that will go through these concepts that I sort of touched on today about what is a bond, what are the different types of issuers, what are the different characteristics of fixed income. So, that's something that, we've always been talking to clients about, but actually being able to create that on our website for our clients to be able to access and sort of read up on it themselves, hopefully will be useful. And then, for myself and other people in Macquarie, always happy to sort of connect with our clients to explain things in more detail and sort of run through our different solutions that we offer to our clients as well to, as Ben mentioned, build into the diversified portfolio.
Yeah, that's amazing. We'll make sure that if you can get it through to us, we'll make sure it's in the show notes. I think that's a great resource for our clients. We'll make sure we get it up on our portals as well. Ben, anything in closing before we let Ed go?
No, just thank you again, Ed. It's always good to get, again, a little bit more detail. Reminds us of a few things maybe we learnt back in the day at uni as well, and then parked it. I was thinking earlier, I studied accounting and finance as well, and then, from there you all go off in different directions. And again, what we do overlaps, but it's very, very different. So it's interesting how many different careers and pathways you get out of that. But I think the thing of looking forward rather than looking back was something that was definitely the same for me. So it's good to hear about the bonds. And again, I couldn't do it, so I'm glad you can.
Yeah, and it's not just me. Like as I mentioned, there's 180 people, or more than 180 people in the fixed income team that I'm sort of standing on the shoulder of giants. You know, I'm representing them when I talk to people like yourselves and our clients, and happy to jump on another podcast. Each of those topics that I sort of touched on at a very high level could be an episode in themselves, right? So appreciate your time in having me on.
No worries, Ed. Thank you, and we look forward to a round 2 and a round 3 in the near future. Thanks again.
Thanks.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.